I would say we should be looking at least to sort of the middle of our year before any proper détente is seen in this war.
Martin Whetton, thank you for joining the business. Just to begin, are markets assuming that all parties are going to actually come back to the negotiating table?
They seem to be, and well, we've seen, I guess, a number of times where we've walked away from negotiations only for them to restart. So there probably is just a general view that one thing will get fixed depending on which leg of the triangle actually works, whether it's the US actually showing some good faith or Iran backing down a little bit and trying to stop the bombing in their own country.
The Strait of Hormuz remains effectively shut.
Yes.
That really hasn't changed since the war began. But how long before this becomes a serious problem for shares and equities?
Yeah, I guess, firstly, there's been a lot of damage done to infrastructure. So you're going to need, the companies who I guess own those assets are going to need to wait till the end of any conflict before they're going to be confident enough to rebuild. But before then, we're just going to have a limited amount of supply come through. A lot of the ships have already left. They've hit their destinations across the world, particularly as far out as Australia or Asia more broadly. They don't really want to turn around and refill or go back. So there's going to be a time when markets move away from this inflation story that they're hitting at the moment, which is the worry around supply and demand at the same time, and start thinking about what this means for long-term growth. That's probably when equity markets particularly, and I would say credit markets as well, start to really feel the pinch of this story.
We're seeing that in debt markets, aren't we?
To a little extent we are, yeah. You saw a big spike up in global yields.
Today, yes.
Today, but we saw them more broadly sort of at the beginning of the war. They've come off their highs, so we're maybe 20 basis points off the highs, but 10-year yields around the world all got to around the 5% mark. And that typically is a bit of a circuit-breaking level. When they got there, it was the story that you started looking at growth down the track and what it would mean, and yields would fall. But the problem is that while inflation stays high and you'll get these second-round effects, pass-throughs, broadly speaking, markets are looking at this idea that the inflation story is going to be a bit wider for a bit longer.
Why wasn't the threat or the plan of a US naval blockade in the Strait of Hormuz enough to really panic markets today? Markets didn't panic. Why?
We seem to shrug off every bit of bad news because it disappears after 24 to 48 hours in the news cycle. You know, a week ago, we were talking about the destruction of a civilization, which for, I guess, normal people was a fairly confronting bit of text over a weekend tweet. And yet, at the 11th hour, I think, or 2 hours before it was due to happen, with B-52 bombers in the air, the whole thing was called off. So it's much like the old parable that parents teach their children of the boy who cried wolf. And we see these things get to a point and come back. And because none of these things have actually ever been in effect, there is a level, I wouldn't say complacency, but maybe just less confidence that it happens.
And it explains the glass half full approach.
It does, yeah.
I mean, just going back to what you said about stagflation and inflation, what are the markets pricing in about those outcomes now? Are we headed towards stagflation or simply a high inflationary environment?
We're looking to a higher rate structure, and the rate structure is the easiest way to look at what the inflation expectations are. If you're looking at things like break-even inflation rates, the level that you need to be compensated for, they haven't really risen that much. So there's a lot of confidence in financial markets, in the debt markets, to say, yes, inflation will go up in the short term, but over time, they believe central banks will take it back to their range that they needed in the 2 to 3%. It's all under control. Now, realistically, that's probably true, and historically that's always happened. It's just that right now you would think that would stay higher for longer, and it hasn't really manifested itself in the way markets are pricing things. What it has done in many ways is taken away this idea that in the short term you'd get rate cuts in many countries, and instead it's put into the forward curves that you'll actually get rate hikes. That's tempered as well. That, like you said, you saw rates go up and then they've come back a bit. part of that's actually in the front end of markets. But in terms of things like equity markets, you really haven't seen a situation that's been so dire that said, gosh, inflation's going to be a big problem for a while and we're going to have no growth. There will come a time when the growth part of the equation actually becomes the bigger part of the narrative.
The Australian dollar hasn't really moved from sort of 69.5 US cents to 70.5 or 71 US cents. It's a bit of a bellwether for risk and for overall global financial market sentiment. What is that sort of lack of oscillation telling you about overall market sentiment?
Well, I think it tells you a couple of things. Firstly, you're absolutely right. It is that bellwether, but that is over a long period of time. What you've seen maybe in the last 18 months is quite a change in the way the Aussie dollar reacts to things. Firstly, it's less of a risk currency, and it's more of a story that, one, interest rates are higher in Australia, policy yields or policy rates are higher. Yields are higher in Australia versus other markets, so there's a natural need to hold Australian dollars and get paid for it. There has been, certainly in the last year, an enormous shift towards Australian dollar assets from non-traditional sources all over the world. That's been a driver. You've got the superannuation funds, which are obviously, as everyone knows, enormous, $3.5–4 trillion, buying overseas assets. There's not enough here for them to do, and so they naturally spread their risk. But at the end of every month, they need to hedge that offshore exposure. And by doing that, there's a need for them to buy the Aussie dollar. So there's a net inflow every month. Fundamentally, gold, iron ore, coal, copper, and gas are all going up quite a bit. So we're a net energy exporter, not in terms of refined product, but in the gross terms. And that's been a tailwind for the Australian dollar as well. So it's less of a barometer of risk and more of a barometer of Australia's fairly unique and strong position fiscally and in terms of interest rates.
Martin Whetton, are you placing yourself financially for a relatively quick end to this war or a prolonged conflict?
My view is it takes a lot longer. I don't think these things can walk away easily. And as I said at the beginning, the time taken to repair a lot of the infrastructure, there's 6 months in that. Now, that's not a war period as such, but I do think that while there are ostensibly 3 parties in this war, one of them probably doesn't want to see a short-term end to things, and the other 2 will battle it out over what points they want to actually get. And I think in the case of Iran, its 10-point plan that it gave was very strong, and it now seems to have an upper hand geographically, but also in terms of its ability to control the flow of oil. Now, that is the thing that, as you know, to extend a pun, is the thing that greases the wheels of commerce, and that will have an influence longer term on that growth story. But I don't think it's in their interest necessarily just now to finish things. So I would say we should be looking at least till sort of the middle of our year before any proper détente is seen in this war.
Martin Whetton, thank you very much for joining the business.
Thank you.